Welcome to Short View Trading. It's Thursday, August the 25th. It's around 9:30 a.m. London time. So what should you be looking at if you're a trader? What should you be focusing on the rest of this week and into next week? Indeed, what should you be thinking about if you're, like us, interested in 1 to 2 week swing trades on equity indices, specifically the S&P 500? Well, that's exactly what we want to talk about in this video. What really matters for markets at this moment in time? Well, it won't surprise you that it's all eyes on Jerome Powell. He's speaking tomorrow at the Kansas City Fed Economic Symposium held at Jackson Hole in the States. Jerome Powell is scheduled to speak at 3 p.m. London time on Friday. The title of his talk is probably Economic Outlook. That's what it says on the Federal Reserve website. The Kansas City Fed haven't actually released as of yet their full agenda for Friday and Saturday. That will come out over the course of the next 24 hours. But importantly, though, it really matters because rate expectations at the moment have been the key thing driving equity markets. And in fact, if you look at the December 2023 implied Fed policy rates, and you can derive that from Fed Funds Futures, if you take DEC 2023 Fed Funds Futures, flip them over, you can pretty easily work out what the implied market expectation for Fed rate as of DEC 2023 is. If you look at those over the course of August, as you can see in the chart in front of you now, the market has priced out a lot of the rate cuts that were expected in 2023. So to be clear, the market expects tons of hikes this year through to the end of the year into Jan, Feb, March next year, but then it was expecting cuts, and as I say, they've been priced out, as you can see on this chart up in front of you now. So about 75 bips of rate cuts priced out of the 2023 contract, and that has been driving equity markets. Now, why have they been priced out? Well, I would argue it's probably because of the language from the Fed governors, the jawboning, the speakers we've had lining up over the last few weeks, talking about markets needing to price out those cuts, or just talking hawkishly and the market taking the hint. So a lot of rate cuts priced out for 2023 over the course of the last few weeks. That's had a big influence on TIPS yields. So real 10-year TIPS yields are a very big driver of the S&P 500 at the moment. And real 10-year bond yields are highly correlated with interest rate expectations. So as the policy rate expectations for 2023 and 24 has changed, so have TIPS yields. And you can see that on the chart in front of you now. At the start of August, TIPS yields not far off zero, and they've backed up moving higher quite notably over the last 3 or 4 weeks. As the Fed has been jawboning, and of course, as the interest rate expectations have been changing for August. So they're all linked. Fed rate expectations, TIPS yields, and indeed TIPS yields and the S&P 500. In fact, as you can see in the chart in front of you now, as TIPS yields was peaking in the middle of June, the stock market was troughing. And indeed, as TIPS yields troughed at the end of July, early August, the stock market was peaking in terms of its relief rally. Went on a little bit longer, but not much. So there's a very strong correlation here between TIPS yields and the S&P 500. And the TIPS yields are deeply correlated to rate expectations, which are driven by what Fed governors, and in particular, what Jerome Powell says. So what we get from Jerome Powell is key. Does he reiterate and double down on the message of the Fed governors' speeches in recent weeks? Or does he take a more dovish tilt, looking at the economy and some of the soft data? Or thirdly, does he up the rhetoric, up the hawkish rhetoric of the Fed governors of recent weeks? All of that will be key to interest rate expectations, TIPS yields, and have a key influence on the markets. But over and above that, it's also pretty important to watch our models, our fear and greed models, our risk appetite models, put to call ratios, and so on. And as you can see from the chart we're putting up in front of you now, this is one of our key risk appetite gauges. They're fear and greed gauges. We have a couple of key short-term models, RAG1 and RAG2, and they're both showing up in this chart in front of you now. And they're picking up the swings on a 1 to 2 week basis in this market really quite nicely. And you can see from the chart, momentum's rolled over. They've peaked out, they've been on sale recently, and they've rolled over and are moving to the downside. So from the basis of these models, it looks like momentum's to the downside, but all eyes on Jay Powell. He has the ability to change the agenda. So that's it from us. If you're interested in hearing more from us on our 1 to 2 week outlook on markets via these videos, please click on the subscribe button, and also please like and share on social media. Equally, if you're interested in our daily updates, our recommendation on equity index futures, the update of all the models, our daily update of our market feel and the mood, then please, if you want to trial the Rag Trader product, please click on the link below. We'll send you the daily Rag, the Rag Trader for free for 21 trading sessions. That's it from us. Thank you for listening. All eyes on Jay.